Ever wondered how you could invest in a broad market segment or an entire index with a single transaction? Well, the magic word here is ETF, or Exchange Traded Fund. Think of it as a basket that holds a variety of stocks, bonds, or commodities. This basket mirrors a specific index, be it the S&P 500 or the Nasdaq. The beauty of an ETF is that it offers the diversification of mutual funds, but with the added bonus of being traded like a single stock. This means you can buy and sell ETFs throughout the trading day, just like you would with individual stocks. Plus, ETFs usually come with lower costs than mutual funds, making them a more affordable choice for many investors. And let's not forget about liquidity. With ETFs, you can quickly and easily convert your investment into cash. So in essence, an ETF is a basket of securities that you can buy or sell through a brokerage firm on a stock exchange. Now that we understand ETFs, let's delve into the concept of index investing. At its core, index investing is a strategy that involves investing in a broad market index, such as the S&P 500. Picture it as a strategy to mimic or shadow the performance of a specific market index. But why would one choose to do this? Well, there are several compelling reasons. First off, index investing is simple. By mirroring a broad market index, you're essentially buying a little piece of the entire market, which can be a lot easier than trying to pick individual stocks or sectors to invest in. Another significant benefit of index investing is its cost effectiveness. Because you're not actively trading and you're not paying a fund manager to make investment decisions, the fees associated with index investing tend to be quite low. This means that more of your money is actually invested, which can lead to higher returns over time. But what about the potential for growth? Well, when you invest in a broad market index, you're banking on the fact that, in the long run, the market will grow. And historically, that's exactly what it's done. Despite short-term fluctuations and occasional downturns, the overall trend of the stock market has been upward. By investing in an index, you're positioning yourself to potentially benefit from this long-term growth. Of course, like any investment strategy, index investing isn't without its risks. It's subject to market risk, which means that if the market as a whole declines, your investment will likely decline as well. However, as we'll discuss later, there are strategies you can use to manage these risks. In essence, index investing is about playing the long game. It's about recognizing that while the market has its ups and downs, over time, it has tended to go up more than it goes down. Therefore, index investing allows you to ride the market waves and potentially benefit from the general upward trend of the stock market over time. There are numerous types of ETF indexes available, each offering unique opportunities. When exploring the financial world, you'll find that ETF indexes come in all shapes and sizes, each tailored to suit a different investment strategy. Let's kick off with broad market ETFs. These are the broadest of the broad, covering entire equity markets. Think of them as a one-stop shop for gaining exposure to a wide range of stocks. For instance, an ETF tracking the S&P 500 would give you a piece of the top 500 companies in the United States. Broad market ETFs are a fantastic choice for those who prefer a set-it-and-forget-it approach to investing. Next up, we have sector ETFs. These track specific sectors of the economy such as technology, healthcare, or finance. Investors who have a strong belief in the prospects of a particular sector might find these ETFs appealing. For instance, if you believe that technological innovation is going to continue at a rapid pace, you might invest in a technology sector ETF. Onwards to international ETFs, which focus on equities from a specific country or region outside of the investor's home country. If you're looking to diversify your portfolio geographically, these ETFs are your ticket to global investing. Now let's talk about bond ETFs. These ETFs invest in a basket of bonds, providing investors with a reliable income stream and a lower risk profile compared to equity ETFs. They're a go-to choice for conservative investors seeking steady returns. Last but not least, we have commodity ETFs. These ETFs track the price of a single commodity or a basket of commodities. Whether it's gold, oil, or agricultural products, commodity ETFs offer investors a way to profit from price changes in these raw materials. Every type of ETF index presents unique opportunities and risks, and it's crucial to understand these before investing. Your personal investment goals, risk tolerance, and time horizon are all key factors to consider when choosing an ETF index. From broad market ETFs to sector-specific or commodity ETFs, there's an ETF index for almost every investment strategy. So whether you're an adventurous explorer or a cautious navigator in the world of investing, rest assured there's an ETF index out there that's just right for you. Investing is not just about returns, it's equally about managing risks. When you step into the investment world, it's like entering a vast ocean. Each wave could either propel you forward or pull you under. That's where diversification and risk management come into play. Diversification, in essence, is the practice of spreading your investments across various asset classes to mitigate risk. It's like not putting all your eggs in one basket, right? Now imagine ETFs as this fantastic basket that holds a wide array of eggs, or rather assets. Instead of buying individual stocks and bonds, you're buying a slice of a much larger portfolio. This allows you to spread the risk and potentially gain exposure to different sectors, industries, and even countries. In the face of market volatility, a diversified ETF portfolio can serve as a buffer, reducing potential losses. It's like having a life jacket in our ocean analogy. So, remember, a well-diversified portfolio can help buffer against market volatility and reduce potential losses. So, we've covered a lot of ground today, haven't we? We've delved into the world of ETFs, highlighting their advantages as a versatile and accessible investment tool. We've also explored the concept of index investing, a strategy that aims to match the performance of a specific market index, offering benefits like diversification and lower costs. We didn't stop there, did we? We navigated through the various types of ETF indexes available, each with its unique characteristics and suitability for different investment goals. And of course, we underscored the importance of diversification and risk management, twin pillars that can help safeguard your portfolio against market volatility. It's a lot to take in, isn't it? But remember, the journey to becoming a savvy investor is a marathon, not a sprint. So keep revisiting these concepts, keep asking questions, and most importantly, keep learning. If you found this video helpful, do give it a thumbs up. And don't forget to subscribe for more insightful content on investing. Until next time, keep investing wisely.